You can forecast the price of stocks to help guide the construction of your portfolio. The Portfolio Weights tool will use your forecasted prices to create a set of portfolio allocations using modern portfolio theory. These potential allocations vary in terms of risk and return. The wider this distribution is, the more variability there is in your potential returns. Since these returns are calculated using your forecasts, the more accurate you are, the closer your expected returns will be to your actual returns. To help you become better at forecasting, we track your historical performance to highlight where you may be over or underestimating the price of stocks. After performing your research on a company, you can create a new forecast by providing the company's ticker, your forecasted high and low prices, and the target date for the forecast. Your forecasted price range should be a 95% confidence interval that the stock's price should be within on the target date. This range is illustrated on the plot with the green area. To edit a current forecast, change either a forecasted price, the date, or both. You can also remove a forecast by clicking on the X. Once you are happy with your changes, click Update Forecast to save your work. The upside table displays the difference between a company's current price and your forecasted high and low prices, as well as the target date for your most recent forecast for the company.